Gold just printed into the $5,176 area on the feed I'm watching. And gold is supposed to be boring. That's the whole point. When gold gets exciting, something underneath is changing. But the real tell wasn't gold. The real tell was what happened next. Silver didn't wait for permission. Silver started following fast. And when silver follows gold fast in an event regime, that's not your normal inflation hedge day. That's the market telling you the bid is spreading, liquidity is thinning, and the system is under stress. One word only in the comments: fast if you think silver is confirming. Fake if you think this is headline adrenaline that fades on the retest. Fast or fake. Quick adult lane guardrail. One breath, different feeds and months print differently. I'm not claiming motive, I'm describing mechanics. Educational only, not advice. Now here's the whole video in one sentence so you stay locked. The first candle is a headline. Normalization is the verdict, and silver's speed tells you whether this move becomes acceptance or gets rejected. Two tells decide everything, and I'm giving you the cheat code early so you don't get faked out. Tell number one: after the pullback, do we get acceptance? 2 hourly body closes holding the decision zone once liquidity normalizes? Tell number two: after the pullback, does stress stay lit or turn off? Measured by spreads, wick behavior, and physical tightness. That's it. Two tells, no narratives. Now let's talk about why gold spike, silver follows fast is one of the most misunderstood combos in markets. Gold can move for simple reasons. Gold is the universal reserve hedge. It's what institutions can buy without explaining themselves. It's what central banks hold. It's what conservative money reaches for when uncertainty rises. Gold can gap up on safety demand alone and still be normal. Silver is different. Silver is thinner. Silver is more reflexive. Silver is high beta. Silver is the asset that tends to lag in calm markets and then act violent in stressed ones. So when gold spikes and silver lags, that's often a contained hedge move. But when gold spikes and silver follows fast, it's often the market telling you one of two things. Either the hedge bid is broadening, meaning it's not just institutions hiding in gold, it's larger participation spilling into high beta hedges, or positioning and volatility mechanics are forcing silver to move faster than it normally would because the tape is thin and participants are scrambling. And here's the key: you do not have to guess which one it is, because the retest will tell you. The first candle is the headline. Normalization is the verdict. If you only remember one thing tonight, remember that, because this is where 90% of people get wiped out. They see gold spike, silver rip, and they chase. They buy the first candle emotionally with size because they're terrified of missing it. Then the market does what event regimes do. It clears leverage first. It flushes the impatient. And then after the pullback, the real move begins, if it's real. So we're not chasing, we're grading. We grade the market after the pullback. Now I'm going to keep geopolitics to one clean line because you're here for markets, not politics. Iran war headlines are being traded as an event regime, and event regimes compress time and amplify volatility. AP is describing Russia condemning joint U.S.-Israeli strikes on Iran as an unprovoked act of armed aggression, warning of serious consequences. That's all you need. War regimes make the tape behave differently. Liquidity providers step back, spreads widen, stops get swept, and price stops moving in smooth steps and starts moving in bursts. Now, there's a phase model you need to understand, or you will misread the entire next 24 to 48 hours. Event regimes move in phases. Phase 1, liquidation, cash first. Phase 2, hedging, safety later. This is why in the first stage of a shock, even safe haven assets can wobble. It's not because the thesis is wrong, it's because cash needs dominate. Margin calls dominate. Forced de-risking dominates. Then phase 2 arrives. Hedging demand becomes the dominant flow. Gold is usually the first beneficiary. Silver can be the second, but when it becomes the second, it becomes violent because it's thinner. That's why silver follows fast matters. It's often the moment you're watching the market transition from phase 1 into phase 2, or at least attempt it. Now here's the trap. A transition attempt can fail. The market can fake you out. That's why we have two tells. Tell number 1, acceptance on the retest. This is the survival tool. This is the thing that separates adults from gamblers. You don't need my exact price levels. You don't need a terminal. You don't need to argue about whether your broker fee differs by a few cents. You need structure. Go to the 1-hour chart. Find the impulse candle that actually kicked off the move. The breakout candle where range expanded and price broke out of chop. Mark 2 lines. The breakout candle's body close. The midpoint of the impulse move. High to low. That band is your decision zone. Rule: after the pullback, if you get 2 hourly body closes holding that decision zone, the bid is real. If you get 1 wick, 1 print, 1 spike, that's noise. That's not acceptance. 2 closes is acceptance. Plain English. If price can live above the decision zone after the pullback, the bid is real. If it can't, If it pops, dumps, and can't reclaim, you just watched headline adrenaline. That's tell number one. Now tell number two, does stress turn off or stay lit after the pullback? Most people only look at the price. That's why they lose. In event regimes, the quote is not the whole story. The supporting signals matter more. So tell number two is a stress checklist, and I'm going to keep it short and visceral, spreads wide, wicks long, tape bursty, fills messy, physical tight. You don't need all five to be screaming at once. If 3 out of 5 stay on after the pullback, stress isn't normalizing. And when stress isn't normalizing, the odds increase that you're not watching a headline spike, you're watching a repricing attempt. Now, physical tightness is the cheat code because paper can fake you in a day. Physical tells the truth over weeks. Here's how you track physical tightness with 0 terminal, 0 excuses. 1 dealer, 1 coin, 1 bar, daily. Track premium percent over spot and lead time. Normal market, red days loosen physical, premiums compress, lead times improve. Stress market, red days don't fix anything. Premiums stay stubborn, lead times stay sticky. That's the difference between fast and fake, and you can measure it yourself. Now, I want to put a structural layer underneath this so you understand why the gold spike matters more in this cycle than in a normal cycle. COMEX inventory has been reported down sharply since October. LiveMint reported total COMEX silver inventories around 366.25 mere ounces as of Feb 20, down nearly 31% from around 532 millimotor ounces in October 2025, and highlighted registered deliverable being reported below 90 millimotor ounces in that window. You don't need to worship the decimal. The point is the buffer has been thinning. Thin buffers do not force price up every day, but thin buffers reduce the system's tolerance for shocks. So when war risk hits, the market is more sensitive. When gold spikes into a high zone, it tells you the hedge bid is active. When silver follows fast in a thin buffer environment, it tells you the high beta hedge bid is activating, or at least trying to. And that's where volatility becomes the product. Now let me be very clear, because this is where channels get irresponsible. I am not saying COMEX defaults. I am not saying there is no silver. I'm saying the system's tolerance for stress is lower. And when tolerance is lower, moves get violent. Violent moves create mistakes. Mistakes create transfers. Transfers create trend. That's the cycle. Now I want to explain one thing about silver that most people still don't understand. Silver has 2 engines. Engine 1, monetary hedge behavior, like gold, but weaker and more volatile. Engine 2, industrial demand, persistent, structural, not emotional. In calm markets, the monetary engine is quiet and silver behaves like a laggard. In stressed markets, the monetary engine turns on and silver behaves like a leveraged version of gold. And when it does that, while industrial demand remains persistent, you get something explosive. But explosive doesn't mean up only. Explosive means fragile. Fragile markets don't resolve gently, they resolve violently. So again, we don't chase the first candle. We grade after the pullback. Now I'm going to give you a mid-video checkpoint because this is where attention drifts. If you only watch one part of this entire move, watch the 2-hour window after the pullback. That's where markets tell the truth. That's where acceptance prints or fails. That's where stress either turns off or stays lit. Now let's talk about what silver follows fast looks like when it's real. When it's real, you see these behaviors. Gold spikes and holds the area. Not perfectly, not without wicks, but it holds a meaningful portion of the move. Silver spikes, pulls back, and the pullback gets absorbed quickly. You see buyers step in higher than the last dip. You see 2 hourly body closes holding the decision zone. You see spreads remain wider than usual but not collapsing. You see physical tightness not loosening on red candles. In other words, the market is stressed, but it's not failing. It's repricing. Now, what does silver follows fast look like when it's fake? When it's fake, you see gold spikes and gives it back quickly. Silver spikes harder, then flushes harder. You see long wicks and no acceptance. You see the move fail the decision zone and not reclaim. You see stress turn off quickly. Spreads tighten, tape smooths out. You see physical loosen on red days. Premiums compress, lead times improve. That's headline adrenaline. It fades. And again, both scenarios can be violent because event regimes whip. So you're not watching, did silver move? You're watching, what did it do after the pullback? Normalization is the verdict. Now I'm going to add a deeper layer for the people who want to understand why these moves can get so sharp around high prices. When gold pushes into a high zone, it triggers 2 things. It forces underhedged portfolios to respond, and it forces positioning to adjust. People who ignored hedges start buying, people who were short start covering, people who were underweight start chasing, and in a war regime, those flows happen faster with less patience. Now silver is where those flows become unstable, because silver is thinner. A lot of silver exposure is held via derivatives and paper instruments, so when the market shifts, silver doesn't glide, silver jumps, and those jumps force more hedging. That hedging forces more jumps. That's reflexivity. Now, I want to keep this as practical as possible because the moment you drift into theory without giving people something to do, retention drops. So here's the practical map. 3 things to watch. Only 3. 1. Does gold hold the high zone or does it give it back quickly? Gold is the anchor. If gold holds, the hedge bid is real. If gold collapses, silver is more likely to flush. 2. Retest verdict in silver. 2 hourly closes holding the decision zone after the pullback equals acceptance. No acceptance equals fake out risk. 3. Physical behavior. 1 dealer, 1 coin, 1 bar. Premium percent and lead time. Does physical loosen on red days or does it stay tight? That's your scoreboard. Now, I'm going to address the biggest misunderstanding people have about war powers metals up. War does not guarantee up only. War creates volatility. War creates liquidity events. War creates phase 1 liquidation and phase 2 hedging. If you don't respect the phase model, you will get emotionally whipsawed. You will buy the spike and sell the flush. That's how markets transfer wealth. So the adult play is to wait for acceptance and judge normalization. Now, I want to speak directly to the 2 audiences because your decisions depend on your time frame. If you're a long-term stacker, your job is not to predict tomorrow's candle. Your job is to understand the structural conditions, stay disciplined, and avoid overreacting to volatility. If you're a short-term trader, your job is to respect the acceptance rule and the stress checklist because event regimes punish overconfidence. They punish leverage. They punish impatience. Now, the risk section, because it's not optional. Event regimes destroy leverage. Slippage increases, stops get swept, air pockets appear. A correct thesis with bad timing can still bankrupt you. If you are trading this, position sizing matters more than your opinion. Now, I'm going to close this loop in the cleanest way possible. Gold at $5,176 matters because gold is supposed to be boring. Gold being exciting tells you the hedge bid is active. Silver following fast tells you the hedge bid may be spreading into high beta. And in a thin buffer environment, that can become violent. So we grade the move after the pullback. We don't argue, we don't cheer, we don't chase, we watch acceptance, we watch stress normalization, we watch physical behavior. Now I want to bring it home with a replayable close that's also an accountability loop. Spike, war, verdict. Spike, gold pushed into a high zone around $5,176 on major feeds, signaling a renewed hedge bid. WAR. Iran escalation headlines are being traded as an event regime, compressing time and amplifying volatility. Verdict. First candle is the headline. Normalization is the verdict. 2 hourly body closes holding the decision zone after the pullback is acceptance. Stress checklist plus physical tightness tells you if the bid is real. Fast or fake. Drop your word now. Then come back after the pullback and reply to your own comment with what printed. That's accountability, not hype. Logic over hype, always.